Hey, what's good? It's your boy Matthew Michael, and in today's video we're going to be talking about covered calls. So if you're new here, please be sure to hit the bell notification icon so that you don't miss any future content or giveaways. I post new videos every week and I would absolutely love to have you as part of the family. Also, please be sure to smash the like button because it really helps to grow the family as well. And if you're interested in signing up for Webull and getting 2 free stocks valued up to $1,400 just for signing up and making a small deposit, be sure to check out the referral link down below in the description. One last thing before we get into the video, I'm just going to take my Instagram and I'm going to leave it right here. Do with it as you will. And without further ado, let's get into the video. Alright, so in this video, we'll be talking about a highly requested topic, and that is selling covered calls. Now, this strategy has several benefits, but I'm going to start with some of the turnoffs. The first one is that you need 100 shares of the underlying stock in order to implement this strategy, which can be capital intensive along with selling puts. And if you haven't seen the video I did on selling puts, be sure to click on the card above or to go down below in the description and click on the link there. And because it can be capital intensive, this is why it can be a good idea to build up a stock position over time, and also why trading options is considered supplemental to trading stocks. The second downside to this strategy is if the stock price rips up way past the strike price that you opened the contract for, and it just happens to go up way past your profit. In this situation, you'll be required to sell all 100 of your shares, and you will have missed out on potential profits. And that right there is one of the worst feelings, especially for all you FOMO traders out there. If I missed any of the downsides, please be sure to let me know down below in the comments. But with those out of the way, let's get into the benefits and why you would want to trade this strategy. The first being the high probability of success. You set the strike price that you're going to sell the call for, so you can set it up to make it where you almost always profit. For instance, say you bought 100 shares of a stock for $50 and the stock is now trading at $100, and you decide you're more than happy taking profits on this options at $100 or more. In this situation, you could sell a call for $105. You can collect the premium, and in this situation you will have profited $55, and you would also get to keep the premium on top of that. Reason number two is it's a great way to grow your money every week. Just think of all the weekly calls that expire worthless. If you want to use this as a weekly strategy, you can just choose to sell at a price that you know the stock's not going to go to, and then bam, it's like taking candy from a baby. And on top of this, if it's a dividend paying stock, you still get to collect the dividend while the contract is still open. And on top of this, you can still make those weekly premiums. This strategy is more passive and more probable than just buying regular naked calls and puts. And the third thing is, whenever you sell a covered call, instead of having theta work against you and you lose value with time, theta actually causes your position to get more profitable as it gets closer to expiration, heavily stacking the odds in your favor. Another thing that selling covered calls works great with is selling cash covered puts. Selling covered calls and selling cash covered puts work together kind of nicely because you can get the shares with the cash covered puts, and then after you get the shares, you can make more money off them by selling covered calls. If you get exercise on your calls, you can sell the puts. And then if you get exercise on your puts, you can sell the calls. It's a cycle, and either way, you're moving the shares around and you're getting paid to do it. And again, if you haven't seen my video on selling puts, be sure to check out the link down below in the description. Watch the video, figure out what that's all about. But I would personally like to know, which strategy do you think is better? Is it better to sell covered calls or cash covered puts? Let me know down below in the comments. If you enjoyed the video or learned anything new, please be sure to smash the like button. Also, if you're new here, please be sure to subscribe and hit the bell notification icon so that you don't miss any future content or giveaways. I post new videos every week, and I would absolutely love to have you as part of the family. And last but certainly not least, thank you so much for watching, and peace.